Hi, thanks so much for tuning in. You're watching BQ Prime. This is the Mutual Fund Show. Now, for those who are looking at the equity markets on a daily basis, there are a few numbers that cause a lot of excitement. 20,000 is one such number, and that's associated with the Nifty 50. Around this time last week, I thought that we would be having a conversation with Nifty 50 at 20,000. They're very, very close to that mark. Now, for those that are looking at the markets on a daily basis, this is very important. But for a large number of investors, this is just a footnote in a very long journey. And for quite a few of those, these are investors into mutual funds. At the same time, these landmarks are great opportunities to talk about strategy and to talk about how to position yourselves in order to make the best of trends that are developing and also to avoid pitfalls that might be emerging in the near to the medium term. Joining me to talk about this perspective is, I think, I don't need to introduce them. You see it for yourself. Kalpen Parekh, who's the MD and CEO of DSP Mutual Fund, and Vinit Sambre, Head Equity at DSP Mutual Fund. Thank you so much, gentlemen, for taking the time. And I hope my introduction has set the context somewhat. But I think I will go to Vinit first, just to give some perspective and to give some context as to why we're talking about 20,000 now. Because if I look at the market and if I look at how we've reached to this point, perhaps to a certain extent, the large caps are playing catch up. You saw quite a bit of a run up in the broader markets. How important is 20,000 in the context of where we are right now?
So, thank you, Alex, for inviting me and Kalpen on the show. And it's great to be talking to the viewers through your show. So I think in the journey, I think 20,000, like you mentioned, is just a number, and maybe at some point we'll see 25,000. At some point we'll see 30,000, and I hope I'll be part of the market by the time we see those numbers. But I think more importantly, this number becomes important from the point of view to sort of keep reassessing as to what, as an investors, were the key objectives with which one basically became part of this equity as a asset class. One should keep reassessing the investment goals what one had. Very important, I think, as an investor, one should keep reassessing what were the risk appetite which the investors actually started when they started the journey, how they have sort of thought about their own risk appetite. And I think from that context, then this number becomes important because to me, I think over the last 2.5 decades of my career, what I've realized is that discipline in terms of, as far as the equity markets is concerned, as far as the long-term investment is concerned, is very, very critical and important. And the magic of compounding, for which most investors are really looking at the markets. Some are really also looking at the short-term returns, but there a lot of risks are imminent. But I think the most important objective is to sort of get the magic of compounding. And when we think about the magic of compounding, the more number of years you spend, your returns actually tend to really show up a magical number. So I think from that perspective, when we talk of this 20,000 as a as a stage at which we are as far as the Nifty is concerned, it's also a good point to sort of reassess, rebalance if the risks has got skewed versus what one had thought. And I think just play the course. The long-term journey is still to be played. India remains a growth market. I mean that at the core, I would say that remains at the core that India remains a growth market. Equity as an asset class will keep chasing the fundamentals of the core businesses, and those core fundamentals, as we see, while there are challenges, but on the at the margin, I think most companies are sort of looking at capturing growth opportunities over the next maybe decades or so. So I think from that perspective, from the investor's standpoint, it is a stage where they need to reassess, be part of the journey, and if risks have got skewed in the journey in terms of the market capitalization, those need to be sort of rebalanced. I mean, that's what I can basically set the context and start my conversation with.
Okay. Kalpen, I'll come to you because I follow you on social media and I've seen a few of your posts. And, it is at these moments where you talk about entry points and you talk about the way that the markets have gone. if I remember correctly, you're the one that posted that your entry point is also very important when you're participating in the markets, because it's not necessary that a consistent approach over a period of time will give you the kind of returns that somebody else, your neighbor, might get a better experience. Of course, you have to have the approach, but how important is that entry point? And from that perspective, where we're standing right now, what should investors bear in mind?
So I always think about it this way, Alex, when I think about investing for myself, that there are three phases of a journey, of a long journey. Let's say you want to go from Mumbai to New York in a 16-hour flight. There is a takeoff phase where you have to be very careful to ensure that your dashboards are all fine, and that's your entry point. Then there is so that takes, let's say, 20 minutes. Then there is a 14, 15-hour steady journey. And then there's a landing phase, which is your exit point. Now, as investors, like Vinit said, real compounding happens in decades, not in years or quarters. So we have to think about investing for decades if we really want to make serious money and convert our rupees into millions. So the 2 points to be very cautious are that if your entry points are in a bubble phase, then you should be a bit worried, because generally, at the peak of a bubble, what tends to happen is something breaks. At that time, past returns look very attractive. Everyone is super positive, and something out of the blue comes, and you see a 30-40% sort of price correction. Generally, these corrections happen once in 8 or 9 years. We saw something, just 3 years back during COVID. So hopefully, we don't see such a sharp correction in the near vicinity. But when these sharp corrections happen, what happens is your 100 rupees drops to 70 or 60, and it takes 3-4 years to get back to 100 again sometimes. So your compounding gets delayed, and your IRRs come down. So I always worry if my entry point is in a bubble, which I don't think is the case right now. I'm just reflecting that today is 26th July. I was looking at data of Nifty on 26th July 1998. I was in NMIMS just passing out from my MBA, and I was in my campus interview. Nifty on that day was 931, so roughly around 1,000 points. Today it is 20 times higher. It's at 20,000. So in this journey of 25 years, over time, the Nifty has only gone up. But there are phases in between where for 2-3 years it may remain constant, or it may not compound at a rate that you and I may desire. It's very difficult to anticipate when will that phase come. But while we talk today, at this point in time, 20,000 is a point in time where all sectors are not booming, or at its peak, or all good quality companies are not at its all-time high. There are many pockets of the market which are at 3-year low, or 4 years low, or a 5-year low. And unlike the past bubbles where there are times to worry, like the year 2000 where everything was at a lifetime high, or 2007 and 8 where everything was at a lifetime high, whether it is the business cycle, the profitability, the margins, the valuations. Right now, there are many cylinders on which markets have to fire. Some of them are positive, some of them are moderate, couple of them could be negative. So I think in balance, we are slightly, ahead of where our normal valuations in the past have been. There are strong reasons for them too. But I would not be too fussed, because like I said, in 98, I started my career when Nifty was at 1,000. Today it is at 20,000. If I'm an investor for the next 10, 20 years, and if you call me again 20 years later, hopefully we'll see a different level.
Certainly. And I think perspective is also important, because we have 20, 21-year-olds entering the newsroom now, and they're looking at 20,000. I recently was at an event where I introduced, and I said that the week that I was born, you had the Sensex that was at 650 and we're at 66,000. So all of these are numbers. They help put things in context. But let's talk about where things stand right now, Vinit, because Kalpen was saying that it's not a bubble. And he kind of elucidated some points as to why that is. But perhaps you'll be able to give us a little more granular detail as to whether or not you, as somebody that decides on where to funnel money, are still finding value. Is it stretched, or is there still pockets of availability? Could you elucidate that point? I know Kalpen said that there are still pockets of opportunity.
So clearly, I think first of all, when it comes to, I was talking to you about the challenges of investment. And when we look at the market highs, I mean, from a very top-down perspective, we know that we are somewhere near the high point, and hence one has to be cautious about how one is actually looking at introducing companies and businesses into the portfolio. Now, portfolio is a mix of many themes or many segments, and the diversification is something which basically blends the both objective of risk and return. And when we look at the matrix today, I think there are pockets which are definitely expensive, and market as a whole is a combination of some expensive names, some moderate, and some there are still pockets of maybe reasonable opportunity. What Kalpen was alluding to. So I would say that when it comes to let's say where there is reasonableness in terms of the valuations, I would simply say that the largest profit pool today is coming from the banking sector, and banking sector is clearly in its highest, it's the highest contributor to the index as well. And when we look at the sector economics at the moment, it remains pretty strong, be it in terms of the asset quality metrics, be it in terms of the credit growth environment, which is basically getting pushed because of this overall economic growth surpassing the expectations. And as I mentioned, the profitability factors are also maybe at a good point. While there are concerns that NIMs have peaked out and they would moderate, but these are all known maybe concerns as of now. So this is and more importantly, when I say reasonable, what has happened is that this sector has not seen the valuations go out of sync when I compare it to some other sectors which have really done well. And there are multiple reasons. Liquidity is one of the factor which has maybe allowed this sector to sort of remain where it is. The other segment where as a house, most of our funds are now having overweight positioning is the pharmaceutical sector in general, where we believe that the last 2 years were not great for that category. The valuations have again not gone beyond the reasonable levels. Valuations are still reasonable. Businesses are generating cash flows. Companies are giving out dividend. They are generating decent ROEs, I would say. And in the cycle, they have had a mixed bag as such, where some part of the businesses were not doing well. So my sense is that being a believer in this, the business cycles, I think the cycles for these sectors should also turn around, and maybe that leads to better valuation metrics for those. So I think likewise, we have a few more segments like automobiles, where while the valuations look rich, but the business cycles are at the lows, and the sector has actually seen that over the last many years, that 2-3 years of good cycle, and then they go back and remain sluggish for a while, and they have been sluggish for the last 3 years. So my assumption is that the next 3 years should see the cycle reversal, and that should basically allow the sector to do well. So I think these are a few pockets where, as a house as well, we have taken a positive view, and that is actually seen in most of our funds as well.
Okay. Kalpen, I was looking at the fund flow data and where investors are putting money. And as of last month, in the year-to-date period, 28,000 crore has flowed into small caps and mid caps. Most of that has flowed into small cap funds, over 5,000 crore flowing into small cap funds just last month. Now, is that cause for concern in terms of investors piling into something that certainly has performed in the short term, but is there risk in the near to medium term that they could lose that capital by trying to catch something that is perhaps a little hotter than it should be?
Yeah, I think anything which becomes such a large wave where there is consensus, generally consensus doesn't make the best returns. And in different phases, we have seen different themes or sectors becoming a consensus trade. So, we do have anxiety when people chase fast returns. And more importantly, it's okay to chase fast returns. See, if I have every month new salary coming in and my SIPs are going on, I can do nothing about it because I'm a long-term investor. But it is likely that if the last 1 year, 3 year, 5 year returns of that segment has been very high or unusually high, the next year or two could see price correction or time correction. And I think some pockets of small caps, not just small caps, many pockets of the market overall also are expensive. So there are more flows chasing small caps. There are more flows chasing engineering and industrials. So there will be these pockets of worry, and we do worry about it. Though we also have very large AUMs in the small and mid cap bucket, but thankfully, normally in the past, whenever we are very worried about the small cap segment, or we think that it is getting into a bubble zone, we have closed flows. We have stopped taking money. We did that last in the year 2017, and then we finally, after a break of 3 years, we reopened our fund after COVID in 2020. As of now, we are comfortable because there are enough pockets in many sectors where we see the business cycle is at a low, or the sector is at a low, or these companies are reviving. They are coming out of margin pressures in the last 2-3 years, and they are improving their numbers. So part of our portfolios still are at less than 15 times multiples, whereas ROEs are 18 to 20%. Growth rates are between 15 to 18%. So we are comfortable, and hence we don't worry much about our portfolio. But at a category level, I would just be a bit more cautious. I would prefer to invest through SIPs than piling in lump sum. And another important data point I would like to highlight is it's okay to invest in small caps or large caps or mid caps as long as the choice of company and the value that you're paying to that company is reasonable and logical. But if the choice of company is wrong, or the quality of that business is wrong, not so good, then there is always that risk of capital loss. If you were to do this exercise of looking at the largest number of retail shareholders for a lot of small cap companies, if you were to sort which are the companies which have largest number of retail shareholders, a lot of these companies don't even have ROEs which can cross cost of capital of 7 or 8%. So those are the pockets where investors should be worried about. So I would only say that if the quality of your businesses is not sound, use this opportunity to book profits and move to better quality companies independent of market cap. So even in small caps, there are good companies. On the other hand, even in large caps, there are expensive companies. So I would not be worried only through the lens of market cap. I would be worried where the company profile is not good, quality is not good. It is a cyclical company. It is having lumpy profits right now, and suddenly market is giving it expensive valuations. Those are the places where there can be risk of capital loss.
Okay. I want to pivot a little bit. And Vinit, before I come back to you on this one, I want to come to Kalpen, because we're on the cusp of a Fed decision that was, it's building up to be something that is momentous, where people are anticipating that this could potentially be the last rate hike. It's not been called, and we've been proven wrong in the past as well. Everyone's been proven wrong when it comes to the Fed. But how much attention are you giving to that as an event? And I was reading the presentation that you sent my way, and you were saying that there are, there is more certainty when you look at fixed income strategy, but there is still a lot of data that you can't make sense of. So how should then the investor position themselves if they're looking at fixed income and their fixed income side of their mutual fund portfolio?
So I sent to you this document called Converse, which we publish every month. And the one that we'll be publishing today should be out very shortly. And I'm reading out from there that our headline today that we are going to release says neutral, wait for weaker data to add duration. Mm-hmm. So we were running 8 to 9 year duration in our portfolios in March, April, and May. When bond yields were at 10-year GSEC was at 740 and 750. It went down all the way to 695. Currently we are at 710. We have booked profits. We are somewhere around 2 to 3 years right now. So we are in the middle. We are not taking any decisive view at this point in time. We feel that for quite some time, for the next few weeks or months, bond yields will remain in a narrow band because there are both types of data points. So when I look at the global markets, also see Fed itself says we will be data dependent and we will decide at different points in time. Most of us have been wrong in the past, so I don't want to claim any authority to say that I can predict Fed action. It'll be naive on my part to say that. But we do feel that so we have a framework of 4 pillars: Indian monetary policy, fiscal policy, global drivers, and other metrics in terms of deciding our rate view. We feel inflation is right now, again temporarily rising in India because of food prices. Oil again has started moving up a bit, and weather-related disruption can happen, and there is a base effect. So inflation for the next few quarters could be slightly inching up. Our growth is reasonably resilient. Normally, resilient growth, lets central banks keep rates where they are rather than cut rates. On the other hand, global yields also, while US data points has softened, US services data is weakening, which gives confidence to their markets to say that Fed should pause or in the next year start cutting. But Fed also many times has said that we want to keep rates higher for longer before we start pivoting and cutting rates. So we will wait and watch how these things progress. The risks are evenly balanced right now on both the sides. So we expect rates to be in a very narrow band of plus 20 or minus 20 from where we are right now. Duration view or a cut duration view. We are somewhere in the middle right now, closer to 2.5 to 3 years of portfolio duration.
Okay, so that kind of gives us a sense of the fixed income strategy. Vinit, I want to come to you with this having gotten cleared out, because I want to understand from your perspective, and thereby my viewers who are more focused on the equity side of things, how they should position themselves, because how much of this data are you paying attention to? If we indeed see a recession, which hasn't been visible, you see resilience in the US. China situation where you're talking about their boost to the real estate sector, no announcement of a wide policy measure to boost the economy. In all of that, we're talking about India growing at least over 6%. So how do you position yourself at this moment?
See, I think a large part of, so equity is more forward oriented, and people try to, build their own forward estimates and try to build that in equity ahead of time. And I think the most important valuation matrix to me is the interest rates in the economy, because that is what eventually leads to changes in the valuation matrix. Now, we saw this rally which took place year to date, both in the Indian markets. We saw that happening in the US market. Maybe I think that is to some extent, I think to a great extent, it is pricing in this prediction that the interest rates has peaked out, and maybe towards the end, I mean, at some point towards the end of this year, we start seeing moderation in that. But let me also tell you that the environment is very fluid. It is, these narratives can change very quickly. I have seen that in the last 2 years since COVID. And I think in general, the liquidity has been the important factor. As the sentiments change, the narratives can change 360 degree, 180 degree, and people can take a very different view. Just that at this point in time, when we are in a very bullish environment, people are just trying to maybe ignore all the negatives as such, which have not yet gone. So, I mean, still there's a chance that inflation can, again head northwards, and that can create some issues. But I think these things are something which equity as an asset class will always have to deal with. More importantly, I think what investors should sort of focus on is the fact that I think the respect to the valuation is very important aspect. As we are looking at the current juncture, maybe we have moved up a bit in terms of the long-term averages as far as the valuations are concerned. And to me, at this point, I think some bit of caution is what I would sort of suggest in terms of the near-term picture, while the long-term, our structural story continues. We are believers of that structural story. But I think near-term, some bit of caution is warranted, given that, the valuations have slightly moved up. But more importantly, it's not that everything is very clear, hunky-dory, things are going to look up only. At the margin, things, there could be, some concerns or worry or some issues which can actually crop up given how the global landscape is. So I think broadly, that should be the overall strategy. And as I said, disciplined approach towards the asset allocation, I think should help in this type of an environment.
Okay. Kalpen, closing comments, then I'll give you 3 scenarios. One, because I have very young individuals in my office that are earning their first few paychecks. So therefore, with Nifty at very close to 20,000, how should they strategize in terms of their investments? 2 is an individual like myself that has been investing for a little over a decade, or maybe a decade or thereabouts, and is on a steady course, continuing to invest in the mutual fund industry. And the third is somebody that has invested for a long period of time and could potentially take money off the table. Should they use this opportunity to kind of book out some of that profit and take money off the table?
Okay, so I'll first give one perspective that today, if I have to put my money, what would I do? And maybe you and I will be in similar bucket. We've been investing for a decade or two, and we are somewhere at all-time highs. But we are not at all-time highs from a valuation point of view. I always would urge viewers to differentiate between all-time price highs and all-time valuation highs. You should worry when we are at all-time valuation highs, not at price highs. Price is like our age. Every day our age will only be at an all-time high, but we don't fuss about it. Or you will not call me to tell me that you are at an all-time high. So for people like you and me, I would say that let's say today bond yields are reasonably attractive at 7% versus 4% just 2 years back. Equity yields are not cheap. They are not most expensive. They are slightly higher than what they should. They are richer. They are not fairly valued. They are slightly higher. So if I have to invest in equity, normally I would be 100% in an equity fund. But this time around, I would not mind putting new money in a hybrid fund like a balanced fund, which has 25 to 30% in bonds. So effectively, I am getting equity at 70% of its current valuation. And whatever I'm keeping in bonds in that hybrid fund, one, it is tax efficient. Second, it is still earning me 7 to 8% return from a portfolio carry point of view. It's not that if you don't invest in equity, you earn 0%. Even parking in bonds today. So I would say that don't quit equities, but definitely it is a good time to bond with bonds. And instead of doing it independently, blend it in a hybrid fund like a asset allocation fund or an equity and bond fund. So that is exactly what I am doing in the last few weeks. Every time I have some lumpy money to invest, that is what I would do. For the third bucket of someone who has had a large share of a portfolio, asset allocation has got skewed higher because of this huge move in equity in the last few quarters. If you have need to spend money on a holiday, or you have to buy an asset or a home, by all means you should take advantage of. End of the day, why do we invest? We don't invest just so that we earn our management fees. We invest to fulfill our goals. So this is a good time if you have a near-term goal coming through in the next 3 months, 6 months, or 1 year. Take some profits out and take advantage of fulfilling that goal and feel happy about it. And for someone who is younger, who is just starting his career, logically you will start with a 20 or 30-year SIP. And when you're doing an SIP, let's assume you're doing a 10-year SIP. Let me not be ambitious for 20 or 30. A 10-year SIP is nothing but 120 installments. You are only investing your first installment at today's valuations or at today's prices. Your 119 installments will happen over the next 10 years, where you will have 3 different phases of the market. Normally in a decade, 30% of times markets are cheap, 30% of times markets are fairly valued, and 30 to 40% of times they are expensive. So to an SIP investor, actually, what is the valuation of the market, what is the level of the market is completely irrelevant, because your money is going to get deployed only over the next 10 or 15 or 20 years and not today, if you're starting today. So if you're starting today, start with an SIP and hope that there are corrections in the market, because you will then be able to add more units. I tell this to my son, who is 17 years old today, that think about becoming a collector of units. And if you want to collect more units, be happy when NAVs are lower rather than when they are higher. So an SIP investor should not worry if there are corrections. He should be happy. And for people like you and me, who are again long-term investors, some asset allocation, some addition of bonds in our portfolio through hybrid funds can navigate us through the next year or two of valuations normalizing or earnings cycle recovering. Like Vinit said, some pockets of businesses are expensive, some are cheap. So this will muddle along. There is no binary view at this point in time that we are very expensive and hence be worried, or we are very cheap and hence be excited. We are somewhere in the middle, like a flight which has already taken off. So now we just have to spend those 10 hours not acting stupid, or just focus on reading something or watching a movie, and let markets continue its compounding.
Fantastic. Couldn't have asked for a better answer. Thank you so much, Kalpen, as well as Vinit, for taking the time and for speaking to our viewers. And viewers, always a pleasure bringing you this show and all of the other shows on this platform, BQ Prime. do follow us and write to us in case you want to hear about something that you really want to know about. In the meanwhile, stay tuned and take care.